Meet Steve. Steve has 7 bank accounts, a current account, an everyday saver, a holiday fund, a crypto wallet he forgot the password to, a Monzo card for coffees, and an emergency fund that currently couldn't even cover a winter heating bill. Steve thinks having more accounts makes him financially organized. It doesn't. It just means more passwords to forget and more decisions to make. And let's be brutally honest about the recent UK economy. Keeping your money scattered in 7 different low-interest pots doesn't make you diversified. It just gives the British inflation monster a multi-course tasting menu. You see, complexity feels like control. But in reality, complexity creates friction. And friction is the silent, ruthless killer of every financial system on Earth. If you want to actually build wealth, you don't need a spreadsheet with 20 tabs. You need a system so simple, a golden retriever could run it. You only need 3 accounts. That is the entire system. One for today, one for tomorrow, and one for the decade after next. Welcome to the 3-account wealth machine. To understand why a 7-account system fails, we have to look inside your brain. Specifically, a phenomenon called decision fatigue. Every time you get paid, a complex budget forces you to make choices. How much goes to the holiday fund? Should I top up the car repair pot? Do I have enough left for the pub on Friday? Each decision drains a tiny bit of your willpower battery. By the time you've reconciled 5 different bank balances, your brain is exhausted. And exhausted brains make terrible financial decisions. You end up leaving excess cash in your current account, or worse, you just abandon the budget entirely by month 3. The wealthy do not use willpower to save money. They use architecture. They remove the human element, meaning you, from the equation entirely. This brings us to the magic number, 3. Below 3 accounts, it's too simple to separate your spending from your wealth building. Above 3, it's too complex to maintain. 3 is the exact intersection of simplicity and function. Let's build the machine. Account number 1 is your current account. Think of this not as a storage vault, but as a busy traffic hub. This account has exactly 3 jobs. First, it receives your paycheck. Second, it automatically pays your fixed bills, rent, council tax, utilities. Third, it immediately sends money to accounts 2 and 3. Whatever is left over after those transfers is your guilt-free spending money for the month. Here is the golden rule for account 1. Keep 1 to 2 months of living expenses here, and not a penny more. If your balance drops below that, you risk dipping into your overdraft. But if you keep too much in here, your money is sitting idle, earning practically 0% interest, slowly decaying in purchasing power. Any excess cash from account 1 immediately flows into account 2, the high-yield savings account. This is your financial moat. In 2026, a decent, easy-access savings account in the UK should be earning you around 4 to 5%. If your high street bank is paying you 1%, they are robbing you in broad daylight. Now, you might be thinking, but I need separate accounts for my holiday, my car, and my emergency fund. No, you don't. Modern banking apps like Starling or Monzo allow you to create spaces, or pots, inside a single account. You get the psychological benefit of separate folders, but the administrative simplicity of one login. Account 2 houses your emergency fund, minimum 3 to 6 months of expenses. It also holds any money you plan to spend within the next 3 years. A house deposit, a wedding, a boiler replacement. It sits here, earning interest, waiting for its mission. Finally, we reach account 3, the investment account. This account does one thing. It builds generational wealth over decades. The rule of thumb here is timeline. If you need the money in under 3 years, it stays in account 2. If the money has 10 or more years to grow, it goes into account 3. In the UK, you have a massive advantage. It's called the workplace pension match. If your employer offers to match your pension contributions, you take it. Always. It is a literal 100% return on your money on day 1. Once you've maximized the employer match, your next weapon is the Stocks and Shares ISA. You can put up to £20,000 a year in here, and every single penny of profit, dividend, and growth is 100% tax-free. Forever. You don't need to be a Wall Street trader. Just buy a low-cost global index fund, like an S&P 500 or All-World tracker. Set up a direct debit and delete the app. You now have the 3 accounts. But the machine isn't complete until we turn on the power supply. Automation. On payday, your money must move before you even wake up. Direct deposit to account 1. Standing orders automatically fire to account 2 and account 3. A good starting framework is the 70-10-20 rule. If you take home £3,000 a month, 70%, £2,100, stays in account 1 for bills and lifestyle. 10%, £300, automatically flows to account 2 for emergencies and short-term goals. And 20%, £600, is relentlessly fired into account 3, buying assets that will fund your future freedom. The beauty of this system is that it requires absolutely zero discipline once it's set up. You don't have to choose to invest every month. You would have to actively log in and choose not to invest. Let's see the machine in action. Fast forward to a bleak Tuesday in November. Your car's transmission explodes. The mechanic says it's £1,200. For the average person, with 7 disorganized accounts and no clear strategy, this is a crisis. Out comes the high-interest credit card. But for you, it's just a scheduled event. Because every month, £50 was quietly flowing into the car maintenance pot inside account 2. The money is already there. You pay the bill, and you sleep soundly. What if you get a raise at work? Do you upgrade your car? No. You absorb the new money into your system. Keep your lifestyle exactly the same for 6 months, and point all the new income directly at accounts 2 and 3. Wealth is rarely built by discovering some secret, complex crypto-staking algorithm. It is built by brutal, boring consistency. And consistency requires simplicity. The complex 7-account budget gets abandoned in year 2 because life gets in the way. The 3-account machine runs quietly in the background for decades. It survives recessions, it survives inflation, and most importantly, it survives your own human flaws. 1 current account for today, 1 savings account for the next 3 years, 1 investment account for the rest of your life. Stop organizing your poverty. Start automating your wealth. If this video helped you rethink your finances, hit subscribe. We decode the mechanics of money every single week. Until next time, let the machine do the work.